You were in Nvidia before it was cool. You were buying it at $4 back in 2014. You rode the wave on this particular stock, Cathie, to 330 back in 2021. But the recent rally, you've missed because the flagship ARK Innovation ETF, you sold out of your main stake back in January. Why?
Yes. So if you... we're very positive on Nvidia. We have been very positive on Nvidia. We bought it down when it hit nearly $100 in the fourth quarter last year. And then it tripled as some of our other AI-oriented stocks stood still. So, we're looking at, believe it or not, many people do not believe this about us. We're looking at relative valuations of names in the AI space. And we were looking at Nvidia at 25 times sales, which is where it is. And Tesla, which is probably the biggest AI story out there, is at 6 times earnings. UiPath yesterday, not earnings, 6 times sales. UiPath yesterday reported it is a beautiful AI play. It too is at 6 times sales. And as far as Nvidia goes, there are a few reasons we take some pause. It still meets our minimum hurdle rate of return, so 15% at a compound annual rate over 5 years. And so you'll see it in some of our more specialized portfolios.
Yeah.
We're looking for the better values. But the risks to Nvidia would include cyclical. When I hear shortages about GPUs or anything, I begin to think about the cyclicality of a group. Competition. Tesla is coming up with its own chip. Meta Platforms, Google, their own chips for more specialized large language models. And then the tech itself. We're learning from Meta Platforms, the Llama model is able to do with less computing power, but more data.
Yeah.
It's able to deliver better models. So there are puts and takes here, as there always are.
How many frustrated investors have got in touch with you via Twitter or the other forms in which you connect with your own purchases of the ETFs? I mean, there must have been a lot of frustration that you kept it in some funds, but not the main ARK ETF.
Well, I'll tell you what has happened mostly is people who understood the Nvidia story. We were pounding the table on it on 2014, really till 2021. And many people actually put it into their portfolios, their own portfolios, and they may have held it. We have not gotten much pushback. And the reason is people know that we are on AI, but we're doing it in a little bit of a differentiated way. Nvidia has become a check-the-box stock. That's why the valuation is where it is. But we are looking for those plays that have not only the vision from management team point of view and broad distribution, but also proprietary data and AI expertise. So we're just pivoting to another set of plays that most people have not discovered yet, much like they did not understand that Nvidia was an AI play really until very recently.
So Palantir you mentioned, or UiPath you mentioned, Tesla you mentioned. There's actually quite a few, though. It seems relatively limited overall AI-focused names that you have. Am I missing something there? Are there far more AI exposure within your flagship fund, or are you really just deciding that there are going to be a few key names that you back?
No, Twilio would be another name. Almost every company, except for, well, actually, even including the multi-omics companies like Exact Sciences, are using their own proprietary data and their broad distribution networks to gather information and create better products and services. So I would say almost every company that we have in the portfolio is in some way, shape, or form. We ask the question, how are you harnessing this powerful tool called artificial intelligence? And I would say 90% of the names in the portfolio are harnessing it and do have proprietary data.
What caught my eye, and we've actually seen so much disruption already to the market capitalization of companies when they have found themselves disrupted by, for example, a ChatGPT. I think of Chegg, the education company, but you noted that Apple, for example, its apps platform could be disintermediated by ChatGPT platforms. Is that a key company that we need to worry about being disrupted? What other names do you think that come to mind that maybe the market has it wrong on how much they could be overwhelmed by this new competitor?
Well, for Google, GPT was either the worst thing that has ever happened to it, or maybe the best thing. We tend to think it's going to be disintermediated, though, by GPT and other chatbots. So we're not going to need the kind of search and therefore advertising that drives Google's model. So we do worry about that one. And as you said, Apple, there are many people who think that even Amazon is going to be disrupted not only by social commerce, so people just shopping through Instagram and other social media sites, Pinterest, but it also could be disintermediated as if consumers use GPT and other AI tools to say, I want exactly this kind of item at the cheapest price anywhere in the world. And it would go directly to that source. So, any platform that has served as, an intermediary is at risk, we would say.
You've name-checked a couple of Meta's things now, Instagram, and you mentioned Llama. Is Meta something that you're doubling down on from an AI perspective?
So Meta is interesting to us. We do like what it is doing. We love its sophistication and the fact that Mark Zuckerberg is now prioritizing artificial intelligence as opposed to the metaverse, which was really what he was focused on last year. So yes, we're interested in Meta's play here. We don't have it in the flagship portfolio. We do have it in other portfolios.
We're speaking with Cathie Wood, CEO, Chief Investment Officer of ARK Invest. Just to go back to where we started in Nvidia, is there any entry point that gets you back in? You've actually been selling out from some of the other funds a little bit, perhaps with the profit you've recently taken in the run-up in the last couple of days. Anything that, despite its heady valuation, make you go, okay, it's not going to be disrupted in the way that we were worrying. We're not going to see the supply chain wreak havoc? Anything for a price, I would say. If this cycle were to worry, we tend to think we're going to have a harder landing than most economists do. If the cycle were to hit it, and Nvidia surprisingly gets hit very hard by cycles because the inventory buildups, and I would say we're in one of those right now, are so spectacular. If we have a combination of a correction and the recognition by the marketplace, perhaps, that some of these models don't have to be as large and don't need as much computing power as more companies use more specialized models. You get the confluence of a reality check. Nvidia is just a very powerful company. They are so exquisitely positioned in the space, but you're paying for it now. But having bought it at $4, how did it make you feel in your stomach when you saw 180 billion added in one day, like it did yesterday?
Well, the frustration yesterday was another one of our AI plays, UiPath, reported a quarter and revealed some products, AI products, and really opened the kimono a little bit more in terms of what it is doing on the AI front. And it's going to be one of the most interesting plays out there, I think. It was down 10% after beating numbers because it talked about the economy being somewhat variable, I think is the word it is using. It was focused on the macros, and that's what analysts focused on. Now it's having a good day. It's up about 10% today, I think.
Yeah, up 9% on the day. So you didn't feel any frustration about Nvidia. You were more focused on UiPath.
Of course. And we publish our trades at the end of every day. And you'll see we bought UiPath in almost all of our portfolios, ARKK, ARKW, ARKF, ARKQ. We use those opportunities when we feel like the market isn't seeing something that we are, especially when it relates to artificial intelligence.
So tell us what you're seeing with XAI. or with Tesla's focus on AI. Today, Tesla getting bought because it's done a deal with Ford on its electrification and indeed the way in which you charge your cars. But what are we perhaps missing when it comes to being the #1 artificial play, as you just said?
Yeah, yes, the autonomous taxi network that we believe Tesla is building, it has more data. Talk about proprietary data. It has more data of real world driving miles than all of the other auto companies and technology companies like Waymo put together around the world, we would say, except for perhaps China, because we don't know exactly what's going on there. And we do believe that the autonomous taxi platform opportunity is a winner-take-most opportunity. The company that gets a person in an autonomous vehicle from point A to point B as quickly and safely as possible is probably going to get the lion's share of the market. And that company will, in the United States, we believe, be Tesla. And we believe globally that opportunity will scale from zero today to $8 to $10 trillion in revenues by 2030. So you can see why we're so excited by Tesla. It is the furthest advanced from an AI point of view, and it's even becoming a manufacturer of factories using artificial intelligence and becoming more and more and more efficient in manufacturing factories and cars. We think it's the most efficient in the world now.
And manufacturing in China, Cathie. And I'm interested in, you referenced this worry about, maybe it's not a worry. You talk about, at least in the US. Are you looking at China? You're remaining exposed to China amid the trade tensions and indeed the tech tensions?
Yes, our history with China after COVID was we plowed in during COVID because we liked what China was doing from a monetary and fiscal point of view. They were not overdoing it. And then, of course, we entered the period starting in November of 20, where managements were basically banished from their companies, and there was one restriction and regulation after another. And so we've pulled away quite significantly. Common prosperity, it seems, means very low profit margins and services that reach into tier 1, tier 2 cities. So JD Logistics and JD, we have some of that, but we have minimized our exposure until China basically seems more inviting to capital once again.
Let's talk politics closer to home. The debt ceiling, many would say debacle, debate, deal still not done, default being uttered. What do you think about that? Are you worried?
With our 5-year investment time horizon and having been around this block a number of times, we know they're going to come to a deal. They are not going to deprive government employees of their paychecks, Social Security, so retirees of their paychecks. It'd be politically disastrous as we're heading into this election year, and already the field has heated up so significantly. So they're going to get through this. It's a very short-term phenomenon. It might be a short-term fix. And hopefully they do get serious about this at some point in time, but we don't think now is the time.
We're speaking with Cathie Wood, CEO and CIO of ARK Invest. You, of course, have been really frustrated yourself with the Federal Reserve. You've said, in particular, inflation is something they shouldn't be looking at. You still think that there's deflation out there, but then when we get a CPE or PCE print like we did today, the personal consumption expenditure, 4.4%, is that still, to you, the wrong data to be looking at, or you think deflation is coming after this swiftly?
Yes, I think when history books are written, we'll look back at this period and we'll see the sharp rise in inflation, which was caused by massive supply shocks from COVID and the war in Ukraine. And you will see, sharp increase, and it feels like it's so slowly coming down. But when you start looking at these charts in history, this decline will look very like it was very rapid, and we will descend into deflationary territory. Don Luswin wrote a piece, it was an editorial in the Wall Street Journal, I believe, about this. And I think the Fed is going to be blamed for sending us into a deflationary period. Already we're getting negative signs for guidance. Home Depot, its same-store sales down 3 to 5% for the year now they're expecting. We got GDI, which is the other side, so gross domestic income, which is the other side of gross domestic product. And they need to equal, but they're at a record gap right now. It's been negative, so in recession territory for the last 2 quarters. And I think many companies are going to feel a hard landing, and it's going to come both from units and prices. I think more and more companies are reporting this on their earnings reports. These economic statistics that take all the oxygen out of the room are hugely lagging, and they're not even getting it right. If you look at the digital world, gross domestic product that statistic was devised in the industrial age. We're in the digital age right now. Yeah. So we pay more attention to gross domestic income, which tends to be more accurate as we're seeing these inconsistencies.